Forget what the news tells you. The truth about tax havens is far more complex, and understanding it could change how you view global finance. When you hear the words tax haven, what comes to mind? Probably a sun-drenched island, a shadowy corporation, and a whiff of illegality. The media often paints a simplistic picture, a black-and-white narrative of greedy billionaires and illicit dealings. But the truth, as always, is far more nuanced, far more intricate, and frankly, far more pervasive than most people realize. Tax havens aren't just exotic locales for the super rich to stash their ill-gotten gains. They are integral, albeit controversial, components of the global financial system. And understanding how they really work, beyond the sensational headlines, is crucial to comprehending the flow of global capital, the power dynamics between nations, and even the future of your own financial landscape. Today, we're going on a deep dive into the labyrinthine world of secret tax havens. We'll strip away the myths, expose the legal mechanisms, and reveal the sophisticated strategies employed by individuals and multinational corporations to minimize their tax burdens. This isn't about condoning or condemning, it's about illuminating a hidden reality that shapes our economies and influences our daily lives. Prepare to have your understanding of global finance fundamentally reshaped. Let's pull back the curtain on the world's most secretive financial jurisdictions. First, let's define our terms. What exactly is a tax haven? It's not just a place with low or zero taxes. A true tax haven, or more accurately, an offshore financial center, OFC, possesses several key characteristics. Low or zero taxation, yes, but also financial secrecy and strict confidentiality laws, minimal or no financial regulation, and a lack of transparency regarding beneficial ownership. Crucially, they often have a stable political and economic environment and a well-developed legal and financial infrastructure that caters specifically to international business. Think of it as a specialized financial ecosystem designed to attract foreign capital by offering a competitive advantage in terms of tax efficiency and privacy. It's not necessarily about hiding money from the law, but about legally structuring assets and income to reduce tax liabilities in higher tax jurisdictions. The line between legitimate tax avoidance and illegal tax evasion is often blurry, and it's a line that sophisticated financial advisors are paid handsomely to navigate. How do they do it? The magic of tax havens lies in their legal frameworks and the corporate structures they facilitate. The most common tools are shell companies, trusts, and foundations. Shell companies, often registered in places like the British Virgin Islands or Panama, are legal entities that exist primarily on paper, with no physical presence or significant operations in their country of registration. They act as intermediaries, holding assets or routing transactions. For example, a multinational corporation might establish a shell company in a low-tax jurisdiction to hold intellectual property, like patents or trademarks. Then, its operating subsidiaries in higher tax countries pay royalties to this offshore shell company, effectively shifting profits from a high-tax environment to a low-tax one. This is known as transfer pricing, and while it can be legitimate, it's also a primary mechanism for profit shifting and tax avoidance. Trusts are legal arrangements where assets are held by one party, the trustee, for the benefit of another, the beneficiary. Offshore trusts offer incredible flexibility and secrecy. They can be used to protect assets from creditors, divorce settlements, or even political instability. Crucially, they can be structured so that the original owner no longer legally owns the assets, thus removing them from their taxable estate. This is particularly attractive for wealthy families looking to pass down fortunes across generations without incurring hefty inheritance or estate taxes. Foundations, similar to trusts, are often used for philanthropic purposes, but can also serve as vehicles for wealth management and asset protection, offering a high degree of privacy and control. The key is that these structures, when set up correctly, operate within the legal framework of the offshore jurisdiction, making them difficult for foreign tax authorities to penetrate. While the term tax haven is often used generically, different jurisdictions specialize in different services. Let's look at a few prominent examples. The Cayman Islands are synonymous with hedge funds. Their legal system, based on English common law, combined with zero corporate tax, no income tax, and no capital gains tax, makes them an ideal domicile for investment funds. The regulatory environment is robust but flexible, attracting massive amounts of investment capital. Switzerland has historically been the gold standard for banking secrecy. While its strict bank secrecy laws have been somewhat eroded by international pressure, it remains a premier destination for private wealth management, offering political stability, a strong currency, and a highly sophisticated financial sector. It's less about zero tax and more about privacy and asset protection. Delaware, USA, often called an onshore tax haven, is a popular choice for corporate registration. Over 60% of Fortune 500 companies are incorporated there. Why? Because Delaware offers flexible corporate laws, a specialized court system, the Court of Chancery, that handles business disputes efficiently, and a tax structure that allows companies to avoid state corporate income tax if their business activities are conducted outside the state. It's a domestic haven for legal and tax optimization. Singapore has emerged as a leading wealth management hub in Asia. It offers a stable political environment, a highly skilled workforce, and a competitive tax regime. While not a zero-tax jurisdiction, its attractive tax incentives for foreign income and its robust regulatory framework make it a magnet for high-net-worth individuals and family offices seeking a sophisticated and secure base for their global assets. The existence and proliferation of tax havens have profound economic and political implications. On one hand, proponents argue they foster global capital flows, promote economic efficiency, and provide a competitive environment for businesses. They can attract foreign direct investment and create jobs in the host countries. However, critics argue that tax havens facilitate tax avoidance by multinational corporations and wealthy individuals, leading to significant revenue losses for governments in higher tax countries. This can result in underfunded public services, increased national debt, and a greater tax burden on ordinary citizens and small businesses. It exacerbates income inequality and undermines public trust in the fairness of the tax system. Furthermore, the secrecy offered by some tax havens can facilitate illicit financial flows, including money laundering, corruption, and the financing of terrorism. This poses a significant challenge to global financial stability and security. International bodies like the OECD and the FATF are constantly working to combat these issues through initiatives like the Common Reporting Standard, CRS, and country-by-country reporting, pushing for greater transparency and information exchange. This brings us to a critical distinction: tax avoidance versus tax evasion. This is where the legal and ethical lines become crucial. Tax avoidance involves using legal means to reduce one's tax liability. This includes taking advantage of legitimate deductions, credits, and loopholes within the tax code. For example, contributing to a retirement account to reduce taxable income, or structuring a business to benefit from specific tax incentives. When a multinational corporation uses transfer pricing to shift profits to a low-tax subsidiary, it is often doing so within the bounds of the law, albeit aggressively. Tax evasion, on the other hand, is illegal. It involves deliberately misrepresenting or concealing income, assets, or information from tax authorities to avoid paying taxes. This includes hiding income in undeclared offshore accounts, falsifying financial records, or engaging in sham transactions. The Panama Papers and Paradise Papers leaks exposed numerous instances where individuals and entities crossed this line, leading to investigations and prosecutions. The challenge for regulators is that the structures used for legitimate tax planning can often be repurposed for illicit activities, and the complexity of international finance makes it incredibly difficult to track and enforce. The legal gray areas are vast, and the resources available to wealthy individuals and corporations to navigate them often far exceed those of national tax authorities. So the world of tax havens is far from the simple caricature often presented. It's a sophisticated ecosystem of legal structures, financial services, and jurisdictional competition that shapes the global economy in profound ways. It highlights the constant tension between national sovereignty, corporate competitiveness, and the need for fair and transparent taxation. Understanding these mechanisms isn't just academic. It empowers you to critically assess global financial news, to understand why certain policies are debated, and to recognize the immense power wielded by those who master the art of international tax planning. The game of global finance is played on many levels, and the offshore world is one of its most significant and often least understood battlegrounds. Are you ready to look beyond the headlines and truly grasp the forces at play in the world of wealth?